Greetings of the day. Now we have come to the chapter 7 of Principles of Insurance book IC01, which is related to terminology of the insurance. So what we are going to cover, that this chapter or this presentation will help you to understand common terms used in insurance. Some terms are very common to the both life and non-life insurance, whereas some terms are specific to life and non-life insurance. It is important to be able to understand these terms and the way they are used, as well as explain these terms as simple insurance. Okay. So you should know there are various terms. There is underinsurance, then there is a reinsurance, and various things. If you want to be in insurance business, you should understand the various terminology. They understand the terms that apply to life and non-life insurance. Understand the terms that are specific to life insurance, and understand the terms that are specific to non-life insurance. So this is very, very important to understand. Similarly, if you are, say, for example, if you are into a marine cargo insurance, then there are different terms documentation which is related to cargo insurance. If you are in the hull insurance, there are various terms. So in the ship, they don't say left side and right side. They say left is a port and right is a starboard side. So it is a bridge and superstructure. It is a forward section and aft section. So it's a navigational bridge. So there are various terminology used in particular trade. Similarly, once you are in insurance trade, you should understand the language what we are using in the terminology, what we are following it up. This is very, very important. So the insurance is a contractual process. Basically, insurance, it is a contract in between the person who takes insurance and the insurance company. So it is a contractual process wherein a person protects their physical assets such as car, home, or maybe life, self-life, or the life of their relatives, children, parents, depending parents, etc. from certain events or perils by transferring the risk to the insurer. So who is the insurer? The insurer is who is taking the insurance. He is the company who is giving insurance policy. So insurer is a company who provides protection by entering into a contract with the person seeking protection from their assets. So you understand what is he is also known as the insurance company or insurer. But then the person who is applying for the insurance protection, he is called the insured. Who is taking the policy, he is insured. He has been insured, he has been assured, he is insured. The insurance process, which starts with the specific application in writing, this is known as a proposal form. So there are design proposal form for various type of risk. The insurance company has pre-designed forms, and which is proposal. This is made by the person who wants to take insurance and includes details of what they want to insure and the type of cover they require. So this is the proposal form duly submitted. It is submitted to insurance company for purpose of getting. So you know what is the insurer, you know what is the who is the insured. Now this proposal form which is submitted to insurance company, it is given to the particular department's underwriter. What is underwriter? It is a supreme position in the insurance company, that particular department, who is considering the risk and is rating the risk. His job is to decide the risk and calculate the premium. So that means you should give the precise information about the risk. If you give a wrong information, the rating could be wrong, and this will come to be a non-disclosure of material fact. At the time of loss, when they find something else not in proposal form, there is every possibility that your claim will be repudiated. So the underwriter is the person who decides the premium, who is rating the risk, whether insurance can be given or not. Naturally, he will consider that this risk is this is not a good risk, this is a bad risk, there is a moral hazard, the person will keep on claiming, and then all these aspects will be checked by the underwriter. If given what will be the terms of the policy, if at all he has to issue the policy, what should be a contractual terms, what clauses should be applied, and what will be the amount of premium to be charged. Naturally, how to rate a risk, that what are the chances of risk, what are the chances of losses of this particular uh, factory product. Because every factory, there are some factories, they are into chemicals, so they are into warehouses, they are storing the hazardous chemicals, and then there are something which is not hazardous, which can never take a fire. So there are certain risks, but naturally, but the flood can damage that one. There would be atoms which is in open. There would be the warehouses all over India, and I want to cover under one umbrella policy. So, considering various aspects related to the risk, the particular nature of the product, the nature of the industry, then the premium is decided in terms of money. And this premium, it is also known as a considerations, that you have to consider the premium you pay. There has to be consideration towards insurance company, you have to pay the premium, and the consideration that has to be paid in exchange for the insurance. So once you pay the premium, you will get the policy with the coverage. So when a person is requesting insurance, agrees to the terms offered by the insurer and pays the premium. So he has accepted the terms which is given in the terms policy, that conditions are incorporated in the policy. The contract is complete and the risk commences. At the stage, an insurance policy is issued by insurer. So you know what is policy, you know what is insurer, you know what is the insured, now you know what is the considerations. This is very important. Having submitted the proposal to the insurance company, and the insurance company is handing it over to the departmental underwriter of that. Say it is a fire policy, it will go to that particular department. It is a marine cargo policy, it will go to marine cargo underwriter. If it is a hull and machinery policy, it will go to hull and machinery underwriter. If it is a fire policy, it will go to the fire underwriter. So if it is a life policy, then the person who is taking care of life underwriting, considering your age, your the physical fitness, etc. So underwriter, first thing what it decides, whether insurance to be given or not given, because there are certain risks. I feel that the quantum of loss, the quantum of the value of this particular atom is too much, and it is too dangerous to give policy to this. Say for example, anything which is for, let us give example, because I am majoritively a cargo and allied machinery surveyor. So whether I should give extension of my coverage of cargo to some of the countries. Say for example, if it is going to Pakistan, if it is going to Afghanistan, if it is going to certain places in say China, to what extent I can extend my policy, the considering there is a transparency index of the world. It is also known as a corruption index of the world. Now, corruption index of the world, in Indian corruption index, we are only 60 to 70% corrupt. So that is the reason 30 to 40% we are not corrupt. Because of this, our corruption index, the foreign underwriters, that is a foreign insurance company, when they accept the risk, they accept the risk only up to Indian ports only. Similarly, when Indians are taking a policy, when the consignment is going to Pakistan or it is going to say Afghanistan via Chabar, in that case, the policy will be restricted to Chabar, because what are the conditions in Afghanistan. We do not know what are the conditions of roads. The terrorism is there. There can be looting of the trucks. So considering all this thing, the policy is restricted for certain terms, and sometimes if it is going to certain places, if the commodity is hazardous, if there is a moral hazard, again try to understand moral hazard. For example, the person who is sitting in Karachi, bhai, he is having a factory. Don't take the insurance for such factory. Because if there is a claim, there can be anything. Anything can happen in that fact. Okay. So whether insurance can be given or not. If it is given, what will be the terms of the policy? Which contract to be issued? Of course, there are standardized policies are there. It is all decided either by London Market or Tariff Advisory Committee or IRDA, whatever it is. But then there is a peculiar contract, which is there is not much. If you are accustomed with that particular contract, you read the clauses, you understand what is covered, what is not covered, and what are the conditions imposed in the policy. So if at all, if you have to give, what will be the terms of policy? Then what will be the premium? See, earlier there was a tariff. It was very easy to find out what should be the premium to be charged. But now it is expected that commercially you assess the risk and you decide your own policy. Earlier from the tariff, people started, lowering premium. It has come to impossible level, and that is the reason what has happened. The claim ratio is much more than 100%. Anyway, that is not the subject, but the rating of premium earlier was tariff based. Now it is individual commercial approach is taken for deciding the premium. Nevertheless, it should be based on the risk associated. That certain things would evaporate, certain things will liquefy, certain cargo will have spontaneous combustion. So all these things, certain hazardous chemicals can have you can say exothermic reaction. There can be explosion. There can be implosion. So considering all this, the risk hazards associated with that particular atom, then the premium is decided. Then what are the important thing insurance contains are what? What are the things in the policy? Subject matter of the insurance. So as a surveyor or as a claims department, whatever you see, what is damage? What is damage? If it is what is damage, it is a say leather shoes, a factory, it is a damage. Is it a subject matter of the insurance or the insurance policy is from the garments factory? So that means you have to see first thing, the subject matter of the insurance is only covered, not any other thing. The address may be same, but the risk has changed from the garments factory in the policy. If it is a typographical error, an insurance company admitting it, that is a different story. But otherwise, the subject matter of insurance should be forming part of your policy. Then what is their second thing? What are the exclusions provided in the policy? There are many exclusions provided in the policy, like non-disclosure of material fact. Then if you are not maintaining utmost good faith. So there are a couple of exclusions. You should be understanding that you see, basically there are policies are divided into two parts. Either it is a named peril policy or it is a all risk policy. In named peril policy, what you have to see, whether the loss is attributable to peril which is covered. Otherwise, and then also the policy is providing certain exclusion. So if it is a named peril policy, you see whether this particular peril was operative. Otherwise, you see it is not falling in the exclusions provided in the policy. Then what is sum insured? Once you see the sum insured, what is, then you have to find out what is the basis of sum insured. Is it on reinstatement basis or it is on market value basis? Is it under insurance or it is over insurance? You see, over insurance is very, you have to look at very with the caution. Over insurance can be with the intention of having fraudulent claims. The under insurance is also there because you want to pay less premium. And then you are sure it will never be total loss or something like that. So sum insured is very, very important. Find out what is the actual value and what is sum insured. So you can always apply the under insurance, etc. And then what is the tenure of the policy? See, life policy is for a particular period. It could be lifetime. It could be for 25 years or something like that. Whereas the non-life policies, general marine and general cargo policies, they are for the period of 1 year. It can be shorter. It can be, say, hull and machinery policy can be for a particular voyage also. But in general, they are given for annual policies are there. Be it a cargo policy, whether it is open cover or open policy, you will have the tenure of the policy as a year and then keep on declaring it your consignment. Similarly, fire policy, machinery breakdown policy. They are the annual policies. So condition of insurance policy. So conditions are precedent. What is that? Which require insured to disclose any material fact to make sure that policy is valid. Again and again we are trying to say that the basic principle is utmost good faith. The basic principle that you have to disclose all material facts related to the risk. If you give a wrong information, if you give a wrong facts about the risk and you are influencing the underwriter to accept the risk at a lower premium at the time of loss, you can always say it is a fraud, it is a non-disclosure of material fact. There is a breach of utmost good faith. So you have to tell about the risk, that it is a inflammable, it is a explosive, this is a exothermic reaction. So all the related, what all the material facts related to the risk has to be disclosed. Age, vehicle, if it is vehicle which is a 30 years old vehicle, and if you say no, it is a new one, it is a non-disclosure of material fact. If you declare a wrong value of the vehicle, it is a non-disclosure, it is an intention of fraud. So then what are the conditions subsequent? So once the policy is given, now you have to give notification of changes while the policy is valid. So if at all there is a change in the risk, if there is certain changes in the risk, then you have to inform insurance company about the changes. For example, my car is a plain simple car without any music system and GPS and uh, all this, the modern age gadgets which you find in the car. So maybe let us assume, which is not possible, but there is no air condition also. If subsequently everything is fitted, naturally there will be enhancement of the value and you should be informing insurance company. Similarly, the furniture, fixtures and fitting, if there is a refurbishment of your building with a new furniture, fixture, fitting, and then the enhanced cost, then you have to inform insurance company that these are the changes. So you have to pay additional premium. So otherwise, if you don't inform, and if it is proved that it was this risk is different than what is covered, naturally the claim can have no problem. The conditions precedent to liability. So this requires insured to give notice whenever there is a loss during the prescribed period, during the reasonable, in fire policy it says it is 14 days. So during the prescribed period, you have to give the notice to the of event happening within the specified period of the time, and also comply with the certain stipulation prior to the occurrence of the loss. For example, conditions of dual control in policy covering dishonesty of the employees. So the what you call this fidelity is not covered. The employee's dishonesty is not covered. Any losses attributable to the dishonesty of employees, naturally the insurance company is taken for the accidents. It is for the fortuity and not for dishonesty or certain type of things. Now you should know what is representation. So it is very, very important that customer has to be truthful in the statement he is making with the insurance company or insurer. The statement which has been on the risk, regardless of whether made in writing, verbal, by a person requesting insurance, is called a representation. You see, nowadays things are difficult. So whenever somebody is making oral representation, immediately on an email or something, you should try to put it in writing that yes, this is your representation. What we have understood is something like this. If there is any changes, please correct it. Although it is a business of good faith, the representation of verbal is also acceptable. But then, considering the present scenario and the present condition prevailing in our everywhere in the market, the representation, the person who is making representation, if it is going against his favor, naturally he may back it out. So that is the reason it is always good to have representation in the writing. Then there are warranties or conditions incorporated in the policies. So what are warranties? It is unlike representation, must be strictly complied with. So warranty, it is a promise, assurance or guarantee made by the policyholder. So warranty is a promissory in nature. I am giving the insurer is giving a promise to the insurance company that these conditions will be met. Whatever the insurance company will incorporate condition, and then having signed that contract, the insurer, the assured will accept the condition. If there is any breach of warranty in general insurance policy, makes the policy voidable. That means the claim with a the breach of warranty. For example, I'll give you a classic example. That I did a survey of one barge. It is a ship. It was having a warranty to ply only in Hazira. When she met with an accident and was totally lost to sea, she was somewhere in the port of Gujarat, not Hazira, but somewhere near Kandla. Now I told that this is the breach of warranty. With this breach of warranty, the court said yes, this is a breach of warranty, and as per Marine Insurance Act, when there is a breach of warranty, the claim can be awarded by the insurance company. So warranties are in a way conditions. So there are different types of warranties. There is a express warranty and there are certain implied warranties. So express warranties will be incorporated in the policy. It will tell you what you should do and what you should not do. So you should know what is the representation, you should know what are the warranties, and then there is a expense ratio. So what is expense ratio? It is the ratio of expenses to premium, and the loss ratio is the ratio of claims to the premium. So for example, I am getting 100 rupees premium, and then with the 100 rupees premium, the loss amount is coming, say, 110%. So what is the loss ratio? 110%. I am getting 100 rupees premium, but I am paying more losses. Similarly, expense ratio is what? It is expenses to premium. It is the ratio of expenses to premium. So that is the expense ratio. And you should know, because these are very, very important from the underwriting point of view. So loss ratios, we have seen the claim ratio and expense ratio. So these loss ratios help insurance company to make a decision for future growth of the business. You see, if some portfolio is making losses, the couple of insurance company are very strict. When the loss ratio is exceeding, say, 60%, then they are very strict, and then they check everything very thoroughly. They suspect there could be possibility of moral hazard. There could be something wrong in the premium rating and marketing. Well, loss ratios are calculated separately for each class of business. They can also be calculated for each class of policy holder. So it is an industry specific and it is a particular discipline specific. That in a particular industry, the fire business is there, marine business is there, marine hull is there, machinery breakdown is there, everywhere, and then there could be sort of health insurance. So the automobile and the motor policies could be there. So you can calculate the ratios for each portfolio, and then try to find out which portfolio is making losses. Generally in Indian market, the motor and mediclaim, these are the loss making babies of the general insurance companies. So the combined figures of loss ratio plus expense ratio is also called a combined ratio, and this figure reflects the overall underwriting profitability. You see, basically there is a feeling that your premium, the losses should not be more than 100%, because if you are making more than 100%, if you are making less than 100% losses, that means you are charging more premium, and then it should not be proper. It is not correct to have profit from such things. You are a custodian of the funds of society, and you should not be making profit. This is a general concept. Of course, it is never followed in its true sense. But then what you have to understand, that if there is no profit, there cannot be any amount kept for my catastrophic loss. There is every possibility after 6 years, 7 years, there would be a cyclone. There would be huge losses. And I have to, if I have to take care of these losses in 1 year, if I cannot, from the premium what I am getting, I may not be in position to pay that. So there has to be profit. So what is incurred claim ratio of health insurance in India? Incurred claim ratio refers to the net claims paid in the insurance company as against the next premium earned. The RDA is publishing information about the incurred claim ratios of all companies every year. The income claim ratio of health insurance company in India is more than 100%. I do not know, I do not remember the precise percentage, but the automobile or the motor policy and this health business, it is not making profit in the sector. Because in the motor, there are the many claims for the third party liability, accidental cases, accidental death, hospitalization. These third party liability claims are much more because the award is not decided by the in the what you call in the premium. The award is decided by the court, considering the a person who is having the earning of say 1 lakh rupee a month, and if he is dying because of somebody's mistake and accident, the award will be different than a person who is earning 10,000 rupees only. So that is to be this is how awards are considered in third party liability. So incurred claim ratio, it is the claims paid during the year plus outstanding claims at the end of the year minus outstanding claims at the beginning of the year divided by premium income. So this incurred claim ratio, this is very important aspect we have to consider. So you should know different type of ratios which underwriters they generate to find out the profitability and also to have control over the underwriting. Now you understand the terms specific to life insurance. So for in life insurance, premium paid initially at the commencement of the policy, this is referred as a first premium. So first premium paid is the first premium. And then the subsequent premium that are paid after the first premium are called the renewal premium. Because every year you have to renew the policy. There is every possibility you may be paying premium after 3 months, 6 months, year, annually. So there are the renewal premium and the first premium. The frequency of premium payment is called the mode of payment. There is an option of limited payment policy, which means premium are paid for the period shorter than the term of the policy. Or if chosen, there is an option of a simple premium policy if all the premiums are paid in the first year itself at the start of the policy. There can be one-time premium also. I don't know, before 30 years, some agent came to me and he said that if you take 10,000 rupees policy, after say 20 years or 25 years, I do not remember, you will get some pension amount. So I said, okay, 10,000 rupees I invested. Now I feel I should have invested more that time. So with that 10,000 rupees invested with the maturity, maybe it is now more than 10 years, I am getting 270 rupees pension. But then you imagine for 270 per month, so it is for 10 years. So I have invested 10,000 rupees and maybe the LIC has given me how much? The one time premium. They have given me, they are giving me the regular pension. Of course, it is 270 rupees. But then what I am trying to say, you should understand. It is possible to have profit of participating life insurance policy or without profit or non-participating policy. So there are various options available when it comes to life policy. Whether you want to take risk, how much risk, whether you want to book profit also. So with the profit policies, they have a business which are payable based on the insurer's profit. Without profit or non-participating policyholder do not receive any bonus, and the premiums for such policies are lesser than which is with the profit policies. So there are various different type of policies, different schemes are available in life. So it is very difficult on a one slide presentation I can tell you everything about it, but you try to understand what is the first premium, what are the renewal premiums, and then what is the profit sharing, non-profit sharing, etc. There are various policies, and if you want to know about it, you will have to go further deep in that particular subject, because LIC life insurance, it's on its own, it is an independent subject. I am not from life side, I am from general side. General side also I am specialized in marine cargo, hull and partially in fire. So if you ask me something about the health insurance, I may not be in position to guide you, because it is a specialized sort of disciplines are there. So you should understand the term specific to non-life insurance, that is a general insurance. So unlike life insurance policies, non-life policies are generally for the short term. These non-life policies are the annual policies, and every year you have to renew the policy. If you suppose you have taken the policy for car, it is for 1 year. Now every year they will give you renewal notice and you have to pay premium and you keep on renewing. If you fail to renew and if there are losses in between, naturally you won't get the claim. So the policy requires renewal every year for it to remain valid. It is not renewed, the policy comes to an end. Unlike life insurance, the risk is reassessed at the renewal time and the terms of the policy may be changed. With each renewal, there is a new contract. You see, in life insurance nowadays, you might have received some spam or the bogus phone call that you have a policy with Bharti Axa and you have paid the. You see, it is like this. There are some people they are trapped when such type of telephone call is there. I know that I do not have any policy taken with Bharti Axa for my health insurance or life insurance or something like that. Now, if it is not there, they say that you have only paid one premium and then it will lapse. So you do one thing, that if you have to continue, you will have to pay 1,50,000 rupees and then you can get the refund of this 2 lakh rupees, something like that. Now it is a bogus and fraud. The moment you should be telling, okay, fine, you give me the branch address, give me the policy, I will go to the branch and you give me the policy, then they will back it up. They will also say that you talk to my senior. Everything is a fraud and bogus. First thing, you don't come in the trap. You should know that if you have paid 50,000 rupees before 8 years, you feel that you have forgotten, you have not renewed your premium. But then people take advantage. Moment someone tells that, oh, you have a policy 50,000, you will get it back. The intention is to get 1,50,000 from you, and then they will stop communication with you. So you have to be very careful, in such type of what you call now cyber frauds. Now there are various terms specific to general insurance, or we can say non-life insurance. So certificates of insurance, this is issued for motor policies, automobile policy, which is giving you evidence that the motor vehicle, as per Motor Vehicle Act, has been complied with. The certificate of insurance must be kept in the vehicle and produced when required by the authorities. Nowadays, you see, it is like this on a RTO site. You put the name of your vehicle number, the you automatically get the expiry date of your policy, expiry date of your PUC. Every information is available on that. So this is all old, but nowadays, nevertheless, if the book says it has to be kept in the car, you have to keep in the car at least for the examination purpose. The practically things are always changing. In policyholder has not had a claim and is going for a renewal of policy, they may be given a no claim bonus. Naturally, if I am not claiming for 5 years and somebody is claiming every year, the premium will not be same for the same type of vehicle, because if I am not claiming, I get a no claim bonus, and that means the reduction in my premium. This is effectively either a discount on their premium or an increase in benefits sum assured in Medicare policies, and it is offered as an incentive. If the policyholder has had a claim and it exceeds a specified limit, the premium is increased. The increase of loading on the premium is called a malus. So when somebody is increasing the premium, it is malus. So if there is a claim, for example, my claim ratio is 120%. Naturally, when I go for renewal, there would be additional premium because of my claim ratio is adverse, and that is known as a malus. So there are different types of policies considering the type of insurance. So there are certain valued policies. These are also known as a agreed value or admitted value policies, where the insurer is agreeing to pay a certain amount at the event of loss without taking into account allowances for the depreciation or appreciation. This is not relevant for the partial losses. So the value is agreed. And then I will not open the topic of valuation. Of course, I can open the topic of valuation if there is any fraudulent intention at the time taking insurance. But otherwise, it is accepted. Then there are full value policies. So where the policy holder states that the sum assured is the true and the full value of the subject matter of the insurance. This type of policy can be used for household goods. So what are the, for household goods, naturally household goods cannot be insured on the reinstatement value. It can be taken on the market value for burglary and for fire or certain thing. Then there are floater policies. So what is the floater policy? These policies are issued to cover the fire risk of stock at different locations under one sum insured. The locations have to be clearly specified. These types of policies can be issued when the total value of the stock at all locations can be declared, but not the value at the separate location. But then there can be restriction that each location it should not be more than 10% of overall insurance. So there should not be concentrated risk at location. So this type of condition also can be incorporated in the policy or are incorporated in the policy. So then there are declaration policies. In cases where there can be a substantial fluctuations in the stock or goods at a location, a declaration policy with provisional premium may be issued. The declaration required to be made periodically. I mean, they will say monthly declaration or 15-day declaration, whatever it is given by the insurance company, and it will show the value of stock or the cargo which is dispatched, etc. during the relevant period. The final premium on the expiry of the policy is determined as the average of the declarations. So this has to be checked. Of course, limits are given. So if my declaration, my sum insured is 1 crore, and when I keep on declaring and now it has exhausted 1 crore, I will have to top up. I have to again increase the sum insured. So marine department, there are different types of policies again, and the system is there. The first thing is the specific policy. That is a specific transit policy, specific voyage policy. So it is one time from Bombay to Ahmedabad. So I have given a policy. There is a sum insured, the atom which is covered, the lorry receipt number, everything will be incorporated, or it would be incorporated, and it is issued for a single consignment and single transit only. For ship also single voyage, that it is only going for a funeral voyage, final voyage, it is going only for the purpose of repairing single voyage. So, or it is going on it is sold, and the delivery I have to give. So such voyages are covered as a single voyage. So it is a single policy. Now there is in marine cargo, there is an open policy system. So this is an open policy. It is a contract for specific period and the time, usually 12 months, and cover shipments as they made. So what is the required? You have to declare each and every consignment which is going. If you are not declaring, there is a non-declaration. So it is not considered. It is a fraud in a way that I am dispatching the consignment with the good faith that it is insured, and if it is reaching in good condition, then I am not declaring at all. So monthly there has to be a declaration. 50. It depends. The insurance company tell you. Then there are the marine open cover. So each individual specific cover will be given, and then the policy will be deducted. So there are increased value policies. What is increased value policies? So I know that once this consignment is coming to India, the value will be more. So I can take an additional policy in Indian market telling that, and I have to prove that why the price is more or something like that. Now people are also asking for either additional markup. So 99% it is CIF plus 10%. So 10% are additional provided over a prime cost, which is taking care of the local transportation, the transportation, and then clearing forwarding charges, and then the profit of buyer. So this being a profit of the buyer, then seller cannot claim that 10% markup. But in the market, people are allowing that markup even to the buyer also. So this is the increased value. Also the duty policy is also there. The custom duty is paid only when the consignment is landed in Indian land, and then only duty is attracted. When I pay duty and when I'm clearing it outside, if there is a total loss of that consignment, then my duty is also going. So my loss is cargo, freight, insurance, 10% towards the local freight and clearing forwarding, plus custom duty. So I should be having that increased value policy. Then you see this is the duty insurance what we are taking. Then the time or voyage policies are insured for hull insurance and are for a fixed term, generally 12 months. Of course, voyage policies for the specific voyage and time policies for the annual policy. ITC Hull, Institute Time Clauses Hull. So there are the contract is governed by Institute Cargo Clauses. They are drafted by Institute of London underwriters and used internationally. Of course, internationally means you can say the United Kingdom places. The American clauses are separate. The Canadian clauses are separate. But then all these other places where the British were ruling, they are following the institute clauses, and they are used. The clauses are used in marine insurance when the goods are being moved from one country to other and clarify the cover, and this clarify the cover. The goods are being moved locally, then the local clauses are used. In India, we have the institute, the inland transit clauses, the A, B, C. The A is a all risk policy, B is uh, the specific perils policy, C is the lesser than the B policy. But B and C are the named peril policies. The perils in the policy are listed what is covered and what is not covered. Now, whenever the loss takes place, the loss can be actual total loss or it can be a constructive total loss. So they are defined into two types of losses, you can say. So what is the actual total loss? It is where subject matter insurance is destroyed beyond the repair. The insured is irretrievably deprived of the subject matter. It is totally pilfered. It is your nothing is there. It's a total loss. It is totally. It is a vessel is sunk. The cargo is damaged to such a, but then that means the cargo or the atom is not available in any form. Whereas what is the constructive total loss? The atom is available, but the repairing charges, the retrieving charges, the refurbishing charges, the salvaging charges, the reflotation of vessel charges, the repairing of cargo, sending it to the repairer to foreign, bringing it back, all these expenses are going to be more than sum insured, or you can say 80% of the sum insured. So that means I have taken the insurance for 100 rupees, and considering all other expenses, the expenses are coming 80 to 85%. So then it is treated as a constructive total loss. And whenever the constructive total loss is considered, salvage value is subsequently considered, not at the time of considering whether it is a CTL or not. That is this is known as a CTL, constructive total loss. So when the actual loss appears inevitable, or the prevention of the actual loss would require expenditure that would exceed the saved value of the goods, the constructive loss is common in a marine insurance, including air cargo. It may also occur in the fire and motor policies where the cost of repair exceeds the value of the subject matter. Then there is an average clause. That is see, there are two types of averages in marine. One is particular average, other is general average. Of course, this is not a subject for general average, etc. But it is used when the insured deliberately understates the value of the average clause. Then, see, average is also known as the loss damage. But the average clause is indicating that the sum insured is less than the actual value of that thing. So the average clause is indicating it is underinsured. If it is underinsured, so it is used when the insured deliberately understates the value of the property insured, and as a result, their contribution to the insurance pool is lower than the risk insured. You see, basically, the insurance is having a pool that I take the 1,000 people's risk with me, and then whenever there is a loss, you pay it to them. But somebody is deliberately insuring it, and he wants it a full value. It is not possible, no. So he will get only the, considering if he is underinsured, he will not get the full repairing charges. He will get the proportionate repairing charges considering the underinsurance he has deliberately obtained. So the event of a claim, the claim amount also would be reduced by the same proportion as the property value is understated. If the policyholder overstated, the value of the amount would not be increased. Somebody will take the over insurance and they will say that no, my loss is, I have taken insurance for 200 rupees. My loss is 200 rupees, pay me 200 rupees. Now you have to see, when I am taking an insurance of 200 rupees of a property of 100, whether it is a fraudulent intention. Because over insurance could lead to a fraudulent intention. You have to be very careful at the time of assessment. So whenever there is a loss, it can be either partial loss or it is a total loss. That means only partly it is damaged or it is totally damaged. And then there are two types of losses. The one is general average loss. Now this is general average. It is a concept in marine cargo and hull. So it is caused by whenever the vessel is in venture, if there is a peril operative which is covered under the policy, and if there is an extraordinary sacrifice or expenditure voluntarily and reasonably made or incurred at the time of peril for the purpose of preserving the property, examples would be cargo jettison thrown off of a vessel or attempt to refloat it, or tugs employed to tow the vessel for safety. So this is declared by general average, and various interests like charterers freight, charterers diesel, the containers on board, the cargo on board, and the contributory value of ship. Considering the overall expenses and the sacrifice, every interest is contributing, and the particular average loss is only partial loss, which is caused by peril insured against, and it is not general average. It is not a general average, but it is particular. One container falls down at the time of unloading, or one container is having some damages and the rainwater enters inside the cargo and damage. So this is not a general loss, it is a particular loss. The concepts of general average and partial loss are terms used in the marine insurance. The meaning of average marine insurance is a loss. Average is a loss. So these are the various terminology what we have seen. So every insurance policy, maybe not in marine, every insurance policy except marine starts with the proposal form. Proposal is given by the insured to the insurer. Insurance documentation is given to insured, will include information detailing the subject matter of insurance, the sum assured, any endorsements, the term of the contract, exclusions, and other conditions attached to the policy is incorporated. Whereas in life insurance, life assurance policies have options of limited payment, where the premiums are paid for the short period of a time, or a single payment where the entire premium is paid at the start of policy only. Each renewal of the general insurance policy is a new contract, and the terms of the conditions may change time to time considering the risk ratio. The premium set aside to cover the cost of claim is called premium reserve. So these are the things what we have seen, various terms of the contract. So all these things, all the contents of this video are only for general information for use. They do not constitute advice and should not be relied upon making for refraining from the making any decision. In case of any omission or discrepancy, the information in the original records will be final and binding. It is also not guaranteed by me that the information in this video is up to date. Things are changing. There are a lot of things are changing. Nowadays the policy issuing, with this introduction of internet and the cyber, a lot of things are changing. I have prepared this presentation for education purpose to the best of my knowledge and ability. Thank you very much. Thank you very much, and all the best to you in the insurance industry.